Big news in the world of Alibaba, as it's been announced today that it will split into 6 different business groups, and the market is liking what they are seeing. The stock is up almost 11% to $95.96 a share. What we're going to be doing today is talking about the split and then taking this to my stock valuation spreadsheet, looking at the latest company financials, and then valuing the stock using discounted free cash flow model, the Ben Graham formula, and the comparables companies model to see if Baba is a buy before the split. So a little bit more on this. Well, the company is splitting into 6 groups, each with the ability to raise outside funding and go public. It's one of the most significant reorganizations in the company's history, and what they said in a statement is this should help unlock shareholder value and foster market competitiveness. And as we said, the stock is up almost 9% in the market, or 11%, sorry. Now, these are the 6 areas in which the companies are going to split. Now, I'm going to apologize for my pronunciation on some of these, but we'll just go with it anyway. The Cloud Intelligence Group, which will be the company's cloud and artificial intelligence activities. Taobo Small Conference Group, which will be the online shopping platforms. Local Services Group, you can see here, this is the delivery service. Kano Smart Logistics, which is the logistics. Global Digital Commerce Group, and the Digital Media Entertainment Group. So overall, as we've seen, this is what's happened to the stock, but since the highs of 2020, the stock has dropped almost 69% since then. Even at its lowest, it was a 80% drop. So can this get back up? Well, let's have a look at my spreadsheet. So firstly, what we'll do is we'll look at my stock summary. We will type in the ticker BABA. And what this do is it will load all the latest company financials. Obviously, this is in Chinese yuan, so what we've done is we've converted it here, and not even Yahoo Finance you'll get these numbers. Look at my Patreon if you're interested in this sheet, but let's have a look at the revenue. So revenue has grown massively since 2018, 36, 54, 74, 104, and 124 billion in 2022, trailing 12 months 125. So revenue is growing massively. In terms of net income, was a big year in 2021, got to highs of 22 billion, but has dropped off massively since then, 9.1 billion. But you can see that was the number previously in 2018. So yes, they've been able to generate a lot of revenue, but in terms of net income, this number has dropped off significantly. If we're looking on whether they're issuing more shares or buying them back, you can see through 18, 19, 20, and 21, they were issuing more shares, and then in 2022, they were buying more shares. So what does that mean for the stock? Well, they were able to generate the capital. If we go to the stock chart here, they were generating capital at this point. They were issuing more shares. If they were issuing more shares in 2020, obviously that was a good thing. And now they're buying them back when the stock is at the lowest it's been in 5 years. So that has worked out very, very well for Alibaba. Next, you want to see if the free cash flow is increasing. What they can do with the free cash flow is they can pay dividends, reinvest in the company. Alibaba do not actually pay a dividend, but they could in the future with these splits. And you can see that free cash flow has increased over the years. Big year in 2021 with 27 billion, dropped down a bit to 13 in 2022. But in the trailing 12 months, 18.3 billion. So it is looking good on that front. Now let's have a look at my discounted free cash flow model. What this does is it calculates the future free cash flows, discounts them to today's value, and gives us a figure here. And as we can see, well, currently it's got it at a $300 stock, but these numbers look a little bit out of sync. So what we're going to do is look at the averages here and see why we think that is the case. So in terms of revenue, I think revenue will actually slow. We will have a look at what Yahoo Finance says in terms of the next few years. And we'll see if our number is close to that. So what Yahoo Finance says is, slowing revenue growth in the current year, 127 to 140 billion. If we compare to what we have there, 2023, let's bring that number down a little bit to 13%, kind of close to what Yahoo Finance is saying. Next, net income margins, well, they've been all over the place. We'll bring the number down a little bit to, 20%. You can see 2022 is the lowest number, but this is because of their low net income. And then net income to free cash flow kind of skewed by this number. They're expecting 39 billion based off lease. So let's bring this down to about 90%. Still, I think these free cash flow numbers are a little bit high, but that puts it to $167 stock. If we were to say that 2022 is a bit more common, and we're going to say that, let's bring this number down to about 50%. It would have it fairly valued with sort of steady growing free cash flow. But if we say that 2021 is closer to what they expect and 2022 is a drop off, then that is the price there. Next, we look at the Ben Graham formula. This is the father in value investing, Ben Graham, and what it does is it looks at earnings per share, the expected growth times by the corporate bond and the average. And if we look at the bond yield right now, currently it is still 4.56 because that is the month of February, shot up dramatically as we can see here. But if we look at what Yahoo thinks for the growth rate of Alibaba over the next 5 years, they actually have it at, well, pretty much flat. So let's add that number in, and also the previous 5 years was 11%. We'll compare that as well. So if we do a 0.47, then it is a $13 stock. Ben Graham would not like this stock because of that. Even if we do 11%, you can see that Ben Graham does not like Alibaba in terms of growth. Now we'll have a look at the comparable companies model. What this does is it compares companies of similar industries, similar metrics, similar enterprise values. And then based on these ratios here, EV to revenue, EV to EBITDA, and PE, it will give a value of the company. So we're going to look at some companies that we think are similar. I suppose the American counterparts will be eBay, and it'll load the values here. Amazon, and then we'll also add JD in there as well, which is JD.com Inc. And this will give us the EV to revenue, EV to EBITDA, which is earnings before interest, taxes, depreciation, amortization, and obviously PE. We want lower numbers here. So EV to revenue, we can see that this is one of the lowest. Closest really is JD.com. And then EV to EBITDA, it is the lowest once again. eBay, because of its negative EV to EBITDA, I'm going to actually take this out. We'll delete the row. And then PE, well, it is a high PE, but obviously Amazon's not profitable at the minute, and JD.com is higher, so it doesn't really like that either. So we will have a look at these values here. According to this, well, in terms of EV to revenue, it is not very well valued, $30. EV to EBITDA, about fairly valued, as you can see here. If it was about the same as JD and Alibaba, as Amazon, it would be a $93 stock. And obviously PE ratio, it doesn't like that because Amazon is not profitable. So we'll even remove this row as well. If it was there, you can see that the average of these is $69, but this is with a 9 cents, 58 cents, and $148 thing. But this is because of the EV to EBITDA. So what we'll do is we'll just undo this again, and we'll have a look and see there. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. And I'll catch you guys next time. Oh, also, yeah, check out my Patreon. Links are in the description. We're making constantly upgrading the sheet. Previously, Baba wouldn't have worked on this sheet, but because we are now doing currency changes and things like that, we can now put in any currency in here, any stock with its financial statements recorded in different currencies, and it will convert them to USD for ease of viewing. Catch you guys next time.